Hey everyone, welcome back to Corporate Decoder, the place where we decode the biggest corporate mysteries just for you. You know how they say money makes the world go round? Well, today we're diving into a SEC filing that shows us exactly where some of that money went and how well it performed. So, buckle up as we break down the latest filings from Northern Lights Fund Trust IV. Specifically, the anchor funds, we are going to make sense of this complex report and find out what it means for investors. And before we dive in, if you appreciate getting straight insights from these dense corporate documents, make sure you hit that subscribe button. We also have a growing community Discord channel linked in the description below where we discuss these filings and more. Alright, let's get into it. This filing is essentially a shareholder report, giving us a look under the hood of a few different investment funds. We are going to focus on the financial performance and what these numbers really tell us about how these funds operated. First up, we have the Anchor Risk Managed Equity Strategies Fund. This fund aims to provide returns through a mix of income and stock growth, while also trying to limit losses when the market is rough. The report covers the period from September 2024 to August 2025. They talk about market conditions, saying the S&P 500 had a strong year, and their fund also did well by using clever hedging strategies to manage ups and downs. They highlight that the S&P 500 had a good year thanks to strong company earnings, and people expecting the Federal Reserve to maybe lower interest rates a bit. Their fund apparently did well too by using tactical ways to handle market swings and unexpected chances to make money. Now, let's look at how the fund actually performed for the advisor class of the Anchor Risk Managed Equity Strategies Fund. On a hypothetical $10,000 investment, the cost for the last year came out to $203. This is about 1.98% of that investment. This means that out of every $10,000 you might have invested, about $203 went towards fees and expenses related to managing the fund. It is like paying a fee for a service, and in this case, it is for managing your money. Looking at the long-term performance, if you invested $10,000 back in April 2020, by August 2025, it had grown to $15,212. That is a decent growth, but let's compare it to the benchmark. The S&P 500 index for the same period would have turned that $10,000 into a whopping $24,063. That is a pretty big difference, isn't it? The fund is trying to be smart about managing risk, but it seems like it left a lot of potential gains on the table compared to just tracking the market. Over the last year, the Anchor Risk Managed Equity Strategies Fund returned about 5.54%. The S&P 500, on the other hand, did much better at 15.88%. Even over 5 years, the fund returned about 5.01% annually, while the S&P 500 averaged 14.74% annually. Since inception in April 2020, the fund has given about 8.18% per year, but the S&P 500 has delivered an impressive 17.88% per year. This really shows you the trade-off between trying to manage risk and potentially missing out on major market upswings. The fund has about $177 million in net assets, which is a good chunk of change. But with only 4 holdings in its portfolio, it is quite concentrated. This means a big part of the fund's performance is tied to a very small number of investments. And what are those investments mostly exchange? Traded funds, or ETFs, making up 99% of the total. The top holdings are the Invesco QQ Trust Series 1 at 65.2% and the Spider S&P 500 ETF Trust at 27.2%. That is nearly the whole fund in just 2 ETFs. This means its strategy is heavily reliant on these large market index funds. Now, let's look at the institutional class of the same fund. The core strategy and market commentary are very similar, but the costs are slightly higher. For a hypothetical $10,000 investment, the costs for the institutional class were $230, which is 2.24% of the investment. This class is a bit more expensive than the advisor class we just looked at. Interestingly, the inception date for this class seems to be September 2016, which is earlier than the advisor class we saw started in April 2020. For this institutional class, the performance figures also show a significant gap compared to the S&P 500. If you invested $10,000 in September 2016, by August 2025, it had grown to $21,394. That is respectable growth. But again, the S&P 500 index turned that same $10,000 into $34,468 over the same period. That is a huge difference. The average annual returns here show the fund at 8.83% since inception, while the S&P 500 delivered 14.77% annually. The gap is substantial. The net assets are the same as the advisor class at $177 million, and the holdings are identical, focusing heavily on those two ETFs. Next, we're shifting gears to the Anchor Risk Managed Income Strategies Fund advisor class. This fund is aiming to provide income. Their stated goal is to capture income opportunities while managing volatility. They talk about market conditions where the Bloomberg US Aggregate Bond Index had a total return of 3.14% and their fund matched it. For a $10,000 investment, the cost for this advisor class were $204, or 2.01%. This is very similar to the advisor class of the equity fund. Now, let's see how this income fund did. If you invested $10,000 in September 2020, by August 2025, it had grown to $10,197. That is a tiny gain, pretty much keeping pace with inflation, if anything. The Bloomberg US Aggregate Bond Index, for the same period, turned that $10,000 into $9,651. So in this case, the fund actually performed a bit better than the benchmark, which is interesting. The 1-year return was 3.14%, matching the benchmark. But since inception in September 2020, the fund has averaged only 0.39% annually, while the benchmark has averaged minus 0.71%. So, while the fund managed to eke out a tiny positive return recently, its long-term performance hasn't been spectacular. This fund is much smaller than the equity funds, with about $26 million in net assets. It holds 15 positions, which is a bit more diversified than the equity funds. The asset allocation here is interesting. It is a mix of closed-end funds at 26.6%, ETFs at 55.5%, and money market funds at 17.9%. They are also holding a significant portion in equities at 58.4%. The top holdings reflect this mix, including things like the First American Government Obligations Fund Class X at 17.0%, Global X NASDAQ 100 Covered Call ETF at 10.8%, and PIMCO Dynamic Income Fund at 9.4%. They are investing in various income-focused ETFs and funds here. One noteworthy change was a 1-for-2 reverse stock split for the advisor class, which basically means for every 2 shares you owned, you now have 1, but the value of your investment didn't change. It is a way to adjust the share price. Finally, let's look at the institutional class of the Anchor Risk Managed Income Strategies Fund. The costs here are a bit higher. $229 for a hypothetical $10,000 investment, which is 2.26%. The performance commentary is similar, noting the Bloomberg US Aggregate Bond Index returned 3.14%. The fund itself returned 2.88%, slightly underperforming the benchmark for the year. Since inception in September 2015, this class has grown a $10,000 investment to $11,393. That is a very modest return. The benchmark for the same period grew it to $11,867. So the benchmark again outperformed. Over the last year, the fund returned 2.88%, while the benchmark returned 3.14%. Since inception, the fund has averaged 1.32% annually, and the benchmark has averaged 1.74%. These returns are quite low, which is typical for bond-focused funds, but still, it's not exactly setting the world on fire. The net assets, holdings and asset allocation are the same as the advisor class. Scrollno, looking at these results more broadly. Scroll, what is my take on all this? Well, these funds seem to be playing it very safe. The equity funds are heavily invested in just 2 major ETFs, which means their performance is going to closely follow the S&P 500 and NASDAQ 100. While they aim to manage risk, this approach seems to have led to significant underperformance compared to simply investing in those indices directly. They are paying management fees without outperforming their benchmarks, which is a classic sign of a strategy that isn't quite hitting the mark. For the income funds, the returns are indeed very low, both for the fund and its benchmark. This is pretty typical for bond funds, especially in recent years with changing interest rates. The performance here is not exciting, but it is also not disastrous. The main takeaway is that they are matching or slightly underperforming the bond market while still charging fees. The big concern across the board is the fees. For funds that are so heavily invested in broad market ETFs or are trying to generate income from bonds, the management fees seem a bit high, especially when the net returns are not consistently beating their benchmarks. These reports are a reminder that even with complex strategies, the simplest approach can often be the most effective. The equity funds might be better off for many investors just buying the QQQ or SPY ETFs directly, and the income funds are providing very modest returns that barely keep up with inflation. That is our deep dive into the Anchor Fund's latest SEC filings. What do you think about these returns and strategies? Let us know your thoughts in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more content like this. And don't forget to join our Discord community, linked in the description for more discussions and insights. Thanks for watching, and we will see you in the next video.